Hello everyone, I'm Ali, and in this lesson we'll look at the going concern assumption. As per ASA 570, during each phase of an audit, the auditor should consider whether it's appropriate to assume that their client will remain a going concern. The going concern assumption is made when it's believed that a company will remain in business for the foreseeable future. Under this assumption, assets are valued on the basis that they will continue to be used for the purpose of conducting a business, and liabilities are recorded and classified as current and non-current on the basis that the client will pay its debts and as they fall due in the years to come. It is the responsibility of management and those charged with governance to assess whether their company is likely to remain a going concern. However, it is the responsibility of the auditor to obtain sufficient appropriate evidence to assess the validity of the going concern assumption made by their client's management and those charged with governance when preparing the financial report. For each client, the auditor will use their professional judgment to assess whether the going concern assumption is valid. There are a number of indicators that alone or combined can suggest that the going concern assumption may be at risk. ASA 570 provides a comprehensive list of events and conditions that place doubt on the going concern assumption. For example, a significant debt to equity ratio. The debt to equity ratio reflects a company's debt status. A high debt to equity ratio or a significant debt to equity ratio is considered risky because it suggests that the company is financing a significant amount of its potential growth through borrowings. Long-term loans reaching maturity without alternative financing is in place. Prolonged losses and inability to pay debts when they fall due. Supplier reluctance to provide goods on credit. High staff turnover, loss of key personnel or strikes, uncertainty around the future availability of a key input or raw material, poor growth planning, inadequate risk management, being under investigation for non-compliance with legislation, competitive pressure, drought, etc. If the auditor identifies risk factors that indicate that the going concern assumption is in doubt, they will undertake procedures to gather evidence regarding each risk factor. For example, if a client has lost number of key long-term long-standing personnel or some key personnel, the auditor may assess the quality of the remaining staff and the likelihood that the client will be able to hire suitable replacements in the near future. Once the auditor has an understanding of the process used by the management, which may include the careful preparation of detailed cash flow projections and budgets, they will assess the adequacy of that process and conduct additional procedures if necessary. If the auditor concludes that the going concern assumption is in doubt, they may undertake further audit procedures. For example, the auditor may do assessment of cash flows. The auditor may do assessment of revenue and expense items and interim financial report. The auditor may review debt contracts. The auditor may review minutes of board and other meetings. The auditor might be having discussions with client management and lawyers. Auditors also consider the mitigating factors which can reduce the risk that the going concern assumption may be in doubt. For example, if a client is experiencing severe cash shortages but has a letter from its bank agreeing to provide additional financing, the letter reduces the risk that the going concern assumption may be invalid. Other mitigating factors include such as a letter of guarantee from a parent company, the availability of non-core assets or segments which can be sold to provide needed cash without interrupting the company's operating capacity. The ability to raise funds via the sales of shares or via borrowings. Auditors also consider the adequacy of client disclosures and financial report about going concern issues. If there are not enough disclosures, the auditor will advise management to give more required disclosures. And then in the next lesson, we will look at the corporate governance structures. Thank you.